Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. Last week we discussed the long-term investment case for emerging markets. This week we discuss the shorter-term investment case for the asset class. Starting with the performance over the past year, emerging market equities continue to underperform their developed market counterparts. While the MSCI All-Country World Index rose circa 12% over the past year, MSCI Emerging Market Index rose only 4%. Within emerging markets, Latin American markets outperformed with a 14% gain over the past year. Asian emerging markets gained a modest 3%, while emerging markets in Europe, Middle East and Africa lost circa 2%. GCC markets in aggregate lost circa 10% over the past year. Now let's look at this divergence between emerging market and developed market performances through the lens of two drivers of returns, namely profitability and valuations. Starting with profitability, as can be seen from the left-hand side chart on display, the long-term average return on equity for both emerging market and developed market corporates has been similar. However, before the global financial crisis of 2008-2009, emerging market corporates enjoyed better profitability compared to their developed market counterparts. Conversely, following the global financial crisis, emerging market profitability switched to a lower gear. As it stands, return on equity for emerging market corporates is 150 basis points below its 20-year average, while return on equity for developed market corporates is 150 basis points above its long-term average. Turning to valuations, as can be noticed from the right-hand side chart on display, emerging markets have always traded at cheaper valuations compared to their developed market equivalents. This can be attributed to a range of reasons, including political risks, currency risks, economic structures, equity index composition, to quote a few. In the recent years, the geopolitical standoff between China and the US has caused investors apply steep discounts to emerging market assets in general and Chinese assets in specific. Also, the valuations seem to be aptly reflecting the lower profitability of emerging market corporates. For the short term, we think a pickup in corporate profitability and improvement in perception towards Chinese assets are important prerequisites for an emerging market outperformance. Closer to home, in the region, GCC equity indices have significantly underperformed their global and EM counterparts over the past year. This underperformance may have a little further to run in our view. Year-end seasonality is not supportive for GCC equities. Oil prices have been falling in recent weeks, and this is not supportive of regional equities either. Corporate earnings projections continue to be revised down for regional markets. This is happening at a time when the earnings revisions at the global level have just turned positive after having been negative over the previous year. We would like to see an improvement in earnings revision trends before we turn positive on the outlook for the GCC as a region. Overall, for emerging markets, we think the long-term investment case is stronger than the shorter-term investment case. For the short-term investment case to improve, two things need to happen. First, corporate profitability should begin to recover, providing the fundamental support. And second, investor perception towards China needs to improve so that valuation expansion comes through. More tactically, we would be selective with our exposure to emerging markets. Within equities, we are overweight Asian equity markets. We prefer selective exposure to China through consumer discretionary and semiconductors, and we are also overweight on India large caps. In the fixed income space, we are tactically overweight emerging market local currency investment grade segment. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. This is Kishore Muktinutalapati signing off.